being posted now. Correct me if I'm wrong on that, but I'm pretty sure I posted all of those up now. So of course I'll be posting up this one. And but what I recall from the last time we met is we still had a little bit of chapter 4 to go. So game plan for tonight is going to be to get into finish, obviously, chapter 4, because we don't have much there, and then get into chapter 5. And I'm going to show you how I'm going to approach chapter 5. I think we may actually finish chapter 5 tonight. Okay. All right, good. Let's go ahead then. And we looked at this last week, but I just want to review with you a little bit about when they gave us example of a full set of consolidated financial statements, and just remembering a couple things that the non-controlling interest, remember, is a subtract from the overall stockholders' equity. So we show all the assets, all the liabilities, the entire stockholders' equity, and then not subtract, but we add in the non-controlling interest portion of the stockholders' equity to get the total equity of the entity. The reason I misspoke and said subtract is when we're dealing with the income statement, remember it's 100% of the revenue, the sales, 100% of the expenses, everything, right? And then what we do is we calculate the overall net income, and then we subtract out that non-controlling interest portion of the net income, since that doesn't belong to the consolidated group. And then when we report our net income, we report that net of the non-controlling interest. Now, when we look at, and I'm just going to jump us over to the statement of stockholders' equity, and notice they kind of have the consolidated piece, the consolidated shareholders, and then they kind of squeeze over what? They squeeze over this non-controlling interest portion of things. So remember, we saw that what the net income was this 65,000, just to go back up. The net income was 65,000 after we subtracted out the non-controlling interest, since that part is only attributed to the consolidated section and not the non-controlling interest. We only bring that 65,000, and then we report out the dividends that were paid out to the shareholders, not the amounts that were reported out to that would have gone out to non-controlling interest. Apparently, there were no amounts declared by the subsidiary here, so that's fine. We would just report in the consolidated business Inc. shareholders part of it, just those dividends that were paid out to the actual consolidated company shareholders. Okay. All right. Now, we really major thing that we hadn't looked at that I wanted to get to tonight was how do you deal with the consolidated statement of cash flows. Now, we've already talked about the we haven't talked, I should say, yet about the statement of cash flows. We'll get to that in F7. Okay, but having said that, I think we know enough about the statement of cash flows to understand what they're telling us to do when we have to prepare a consolidated statement of cash flows. Now, remember, statement of cash flows does what? Takes the balance sheet analysis and the income statement after those have been prepared, and then the statement of cash flows flows off of an analysis of those two statements. Well, that's very, very similar to what we're going to be talking about for consolidated statement of cash flows. Okay, but they do give us some steps in how to take the consolidated balance sheet and the consolidated income statement, and then follow some of these steps into making a consolidated statement of cash flows. And since this is steps, I think it's a good idea for you to flashcard this. Remember, guys, the process is what? The process is come to class, participate in the lecture, note the flashcard suggestions, make the flashcards, memorize the flashcards, and then do the homework, right? That's the process so that you're reinforcing the key concepts as we go through. And I think this is very helpful because it gives us steps. So if you memorize these steps and then you're looking at a question or maybe even a task-based simulation homework question, where they're asking you to prepare a consolidated statement of cash flows, you're going through and applying these methods that we're talking about here. So we say that the net cash spent or received in the acquisition must be reported in the investing section on the statement of cash flows. So in the period that you acquire control of this company, you're going to have to distribute some cash to acquire the company. That is going to be shown when you buy the stocks of another company. That shows in the investing section on the statement of cash flows. Okay, but it's the net cash. So they give us an example here, which I think is helpful. If the parent had to spend $2.5 million to acquire the subsidiary, and the subsidiary had $800,000 cash, well, when you acquire the subsidiary, right, you're giving the cash, the 2.5 off to the shareholders that you're buying the company from. But when you buy the company, you get control of whatever's in the corporate accounts, this 800,000. So in the investing section on the statement of cash flows, you show a net cash outflow for that transaction of what? Of 1.7, the 2.5 that you paid to the shareholders minus the 800,000 that you're acquiring of cash because you've acquired control of the cash of the corporation. Now you come over and you take a look at the second step. I can't tell you how good it feels to talk to accountants. You know, I talk to non-accountants in my Stanford classes, and it's just like I don't know, they're really, really bright students at Stanford, but they're not accountants. And anyway, okay, so let's go ahead and let's take a look at the second question. We say the assets and liabilities of the subsidiary on the acquisition date must be added to the parent's assets and liabilities at the beginning of the year in order to determine the change in cash due to the various sections of the statement of cash flow. Because remember, we look at the change in accounts receivable. We look at the change in current assets, current liabilities to calculate the cash that was used, for example, or provided by operating activities as we make our adjustments to net income. So you would have to combine the beginning balances of the parent and the subsidiary and then compare that to the consolidated amounts that you have generated as you perform the consolidation to figure out what the changes are in cash, again, in the operating, investing, and financing. So again, and guys, this can be one flashcard. I'm just continuing the flashcard with step one on the previous page, step two over here, and then we have this example. A parent company reports note payable of $600,000 on January 1st to acquire a subsidiary on May 1st. The reported notes payable of $250,000 at the acquisition date. The December 31st consolidated balance, now that's both companies, is $750,000. So you would take what? The beginning parents, add the subsidiaries, that's that May 1st number, the $250,000, subtract the ending balance, and then that would have generated, in this example, a cash outflow that since it's a long-term note, and I guess they probably should have told us it was long-term at the beginning, because if it was a current liability, it'd be up in the operating section, but since it's long-term note payable here, then I guess since it's a note payable, not account payable, I see, John, it's a note payable. So since it's a note payable and they're now calling it out as long-term, of course, that would be showing up in the note payable. It would be showing up in the financing section of the statement of cash flows. Okay. Now, when you go into subsequent periods, and they tell us in subsequent periods, the preparation of the consolidated statement of cash flows is simplified by the fact that you now have the consolidated balance sheet, the consolidated income statement, and you can now just go ahead and prepare your statement of cash flows like you would any statement of cash flows. Okay. But there are a couple of things that are unique to the consolidated that you want to flashcard here. Okay, so what are the following considerations in subsequent periods when reconciling net income to cash provided by operating activities? Total consolidated net income, including net income attributed to both the parent and the non-controlling interest, should be used. So you wouldn't do that little subtract that we saw for the net income calculation. You use the entire net income that is attributable to the consolidated and the non-controlling interest. The financing section should report dividends paid by the subsidiary to non-controlling shareholders. Dividends paid by the subsidiary to the parent company should not be reported because you don't pay a dividend to yourself, right? Now, of course, the dividends that the corporation paid, that the parent paid out, yes, those would be subtracted in the dividend section. And then the investing section may report the acquisition of additional shares by the parent if the acquisition was on open market. In other words, it's not one of these deals where the subsidiary reached into their unissued stock and issued additional shares to the parents, because again, you can't issue shares to yourself, right? Okay, but if they acquired those on the open market, then it's seen as additional investing activity. Okay, good. Flashcard that. And then we have this comprehensive example where they're going to give you information and you're going to go through and you're going to apply all of these different things that we've been talking about now for the last couple of classes, right? As we went through really just last class and tonight as we've gone through the consolidation process. Okay, now this is a comprehensive example. I'm not going to go through it with you tonight for the sake of time, but I do want you to go through this entire example so that you can see all the entries that you would make as you prepare the consolidated financial statements. They give you an entire spreadsheet with all the entries, so you should walk through all of that, understand all of this process. And then, of course, you would know then what the year-end entries are. And we've dealt with various pieces of this as we've gone through the example. So we went through a piece at a time. You should be able to now follow that whole process and see how all those entries that would be made in the generation of the consolidated financial statements. There's also a task-based simulation associated with this homework that I recommend you do now so that you start to build up some of that understanding as to how to more comprehensively go through something that would be a task-based simulation. Okay. Okay, with all that, let's go ahead now and let's take a look at our first multiple choice question for tonight. And I will go ahead and launch the poll for us. That's 3 minutes. I'm going to give you a little more time. This is a hard question. I put this in the category of hard. Okay, guys, I'll give you 10 more seconds. Okay, I gave you a little more time than you should. I'm going to end the poll. Gave you a little more time than I should on any one question. You know, you should never take more than 3 minutes. Okay, but I wanted to give you a little bit more time because this question, in my opinion, is the type of question you would see in your last multiple choice test, testlet. Remember that the question, that the exam is multi-stage testing, gets more difficult as you go along. Okay, so you would probably see a hard question like that in that last multiple choice testlet. But I'm pleased to see that a good 82% of us got it correct. The right answer is C. Okay, and the couple of folks that chose A, okay, I kind of see why you chose A, because maybe you couldn't figure out what to do with this question. You say, well, I know that when I prepare the consolidated stockholders equity, that I'm going to pick up what? I'm going to pick up the parents' 270,000, right? I pick up all of their common stock, all of their APIC, all of their retained earnings. So, and of course, you couldn't have got to any of the choices without the 270, or you know, the 270 was the minimum, I guess it could be. So you say, well, at least I know that part. Okay, but you have to do what? You have to pick up the 270, but you also have to add in what? The non-controlling interest part. And that's probably where some of you were struggling a little bit, and intentionally this question wanted you to struggle with this. So what you need to do is figure out that non-controlling interest part. And remember, we said, you might have forgot this from last time, that the non-controlling interest piece is what? Is like the retained earnings of the non-controlling interest. Okay, so like the statement of retained earnings of the non-controlling interest. So when you look, you'd say, well, if they're asking me at December 31st, year one, and at year one, there was what? 36,000 in the subsidiaries non-controlling interest, then my beginning balance in the subsidiaries, not non-controlling interest, but the subsidiaries retained earnings was what? Was 36,000, right? I know that. And then they give me what? They give me the December 31st. So I know that the ending balance must be what? Must be 51,000. Not must be, it is, because they're telling me it is, right? Okay. Then what? Then up here in the paragraph information, they tell you that they paid a dividend of 5,000. Well, you know, the dividend would be what? Would be a subtract from the retained earnings of the subsidiary. So I have the dividend here of 5,000. So if I'm sitting there and I subtract it from some number, and that some number would have been the add, that would have been what? The net income of the subsidiary. So if I sit here and I kind of squeeze up, I have what? I have 56,000 was the subtotal. And if 56,000 was a subtotal, then I must have added what? I must have added 20,000. So the subsidiary's net income was what? Was 20,000, wasn't it? Okay, now that I know what the subsidiary's net income was, then I can go ahead and take that 20,000. And if I acquired what? 80%, that means that what? The non-controlling interest portion is 0.2, or what? $4,000. So now I know the net income that went to the non-controlling interest. So now I can go ahead and say, well, look, if I'm sitting here and my beginning non-controlling interest portion was what, and I have to figure that out. I have 120,000 that I paid for what? For 80%. So 120,000 divided by what? 0.8 means that I have 150,000 is the total company, times 0.2 means that the non-controlling interest beginning amount was what? Was 30,000. And then I'm going to go ahead and do what? Add the non-controlling interest portion of the net income. Non-controlling interest portion of the net income was just calculated 4,000. The dividend, total dividend was what? 5,000, of which how much goes to the non-controlling interest? 0.2. So the dividend that's subtracted is what? Is 1,000. And so now the ending balance in the non-controlling interest, which is what I needed to answer this question, is what? 33,000. So I take the parents plus the non-controlling interest that I just calculated, 33,000. That gives me choice C, this 303,000. Pretty hard question, right? Maybe you would have done this first. I might have shown you backwards. You probably would have first figured out what was the beginning balance of non-controlling interest. What was the net income? You look around, you don't know. So then you'd probably have to go and do all this, and then it would be fairly easy from there. But this probably would have been where you would have started. I might have shown it to you a little backwards, where you would have said, hey, 120,000 for 80% of the company means the whole company's worth 150, means the non-controlling interest at the beginning is what? 30,000. Then we add their net income, we subtract the non-controlling interest dividend, and that gives us the ending balance here. Question? Okay, good. Let's go ahead then, if we're okay with that one. Most of us who tried it got it correct. And I could see why folks that didn't get it correct maybe chose when they did, but I think you saw now how to analyze that non-controlling interest was the hard part. Okay, good. Let's go ahead and let's put the poll up for this one. Oh, we did this one. We did this one. We don't have to redo this because we did this in class last time, this question 2, which is basically the reminder is that you only take the income from the period that you acquired the company forward, right? And the consolidated income. Okay, that was the big deal there. Okay, good. Let's go ahead then, if that's, since we already looked at that one, let's look at this one. Okay, guys, we're about 2 minutes into this now, so I'm going to go ahead and end the poll. And looks like everybody who attempted it, there's maybe a couple of us that aren't participating, guys. That's not the way the class works. So stop doing whatever the other thing is that you might be doing and participate. Okay. You get better at this stuff by trying it in class and then working your homework questions and then doing your final review. And by the time you're in the exam, you should be a CPA exam test answering machine. Okay, but the journey starts here. Okay, in class. Okay, now you take a look, and everyone who tried it though did get it right. Okay, so that's good. That's 100%. So let's just look at this one. And when you look at this one, it gets a little bit confusing because you're like, why are they telling me all this other stuff here? And the answers, one of two answers. One, they're putting all this in here. Let me just get this, let me get the poll out of the way. The answer is they're giving you all this stuff to boggle your mind, to confuse you so that you can't see the very straightforward way of answering this question. Or there could be what? A series of questions that follow on with this same fact pattern, right? So they'll say using the information from the previous question, et cetera. So, that could be the reason too. But I'm thinking this one just wanted to distract you with a lot of nonsense. Okay, but let's just take a look at it. And they tell us that on January 2nd of the current year, Peace Company paid $310,000 to purchase 75% of the voting shares of Surge Company. Peace reported earnings of $80,000 and Surge reported contributed capital of $300,000 and retained earnings of $100,000. The purchase differential was attributed to depreciable asset with a remaining life of 10 years. I look at that whole set of information and I'm like, who cares? And none of that matters to me in order to answer this question so far. Then Surge reported net income of $20,000, paid dividends of $8,000 during the current year. Peace recorded income inclusive of its income from Surge of $30,000 and paid dividend of $15,000. What amount will Peace report as dividends declared and paid in the current year consolidated statement of retained earnings? Now, they're saying the consolidated statement of retained earnings. And so we know that we've got to pick up this $15,000, right? Okay, that's what they paid. The parent paid that. That's going to be part of the answer here, so I can get rid of this. Okay, now the question is, do I need to adjust it for the non-controlling interest piece? And what was stupid about this question, they were asking me about that consolidated piece. Remember when I showed you the consolidated, that CBI company? That's the part they're asking me about, not the total. Because the retained earnings that are paid out in the non-controlling interest might show out there on that column, but that's not the consolidated piece. But let's say I'm thinking, well, do you mean on the entire consolidated statement of retained earnings or just on the piece that's attributable to the consolidated company? Is that what you mean by consolidated? Well, let's try to bring in the amount of dividend that was paid to the non-controlling interest. And it said they had dividends of what? They had dividends of 8. And if you take 8,000 and you multiply that by what? It'd be 0.25 would be their share. That would give them what? 2,000 for the non-controlling interest. And if I pick up 15,000 and then I say, well, they wanted me to include the non-controlling interest column down there on that statement of retained earnings, that one that we're looking at later, the answer would have been what? 17,000, which they don't give me. So they gotta just be talking about what? That one little, not that one, but the big piece, not the little, but the big piece that was just contributed to the, attributed to what? To the consolidated entity. Question. You probably could have got rid of this too pretty easily because what? That's adding the two together, which you don't report a dividend being declared to yourself. So you probably could have got rid of that one. So you could have turned this into a 50-50, and then 15,000 would, to me, be the only answer that would make any sense there regardless. So, okay. Okay, good. Now you come over and you take a look at impairment of goodwill. Now, we talked about impairment of fixed assets and intangible assets with a finite life, right? Patents, those sorts of things. We talked about that. Remember, it was all about the cash flows, right? If we are going to recover the carrying amount of a fixed asset or a intangible asset with a finite life, then we look at the cash flows. If we're going to recover that, there's no loss. If we're not going to recover those undiscounted cash flows, then we discount the cash flows, et cetera. Remember all that? Okay, and then I told you, well, we'll get to goodwill in this chapter, because in goodwill, we have to treat it a little bit differently because it has what? An indefinite life. We don't really know when goodwill is going to, if ever, going to end for a company. Okay, so what happens? We come down and we talk about the reporting unit. Okay, now when we're dealing with goodwill impairment, okay, what I want you to flashcard right now, okay, is evaluate. When I say flashcard right now, I mean, I don't mean you have to write the flashcard right now, but I want you to right here, put your flashcard, evaluate each reporting unit separately. Evaluate each reporting unit separately. Evaluate each reporting unit separately. Okay. Now they tell us, and I want you to flashcard down here. Okay. That a reporting unit is an operating segment or one level of an operating segment. And this is the main thing on this flashcard. The goodwill of one reporting unit may be impaired, while the goodwill of another reporting unit or units may not be impaired. Why? Because you're going to evaluate if you have goodwill impairment on each reporting unit separately. Okay. Now you come over and let's take a look at the next page. And they talk about the qualitative evaluation of goodwill impairment. Let's talk about that. Entities have an option to perform a qualitative evaluation to determine whether it is more likely than not that goodwill is impaired. The quantitative impairment test is not necessary if after assessing relative qualitative factors, an entity determines it is more likely than not that the fair value of the reporting unit is less than its carrying value. So just flashcard that just in case somebody asks you something stupid that you could bring in qualitative evaluation. Okay, now come over and let's take a look at this example. And again, the mantra here is what? Evaluate each reporting unit separately. I'm not sure if I'm spelling separately correctly. I don't care. Okay, evaluate each reporting unit separately. All right, now let's go ahead and take a look. And they tell us that Omega, this corporation, has two reporting units. Here we go. Two reporting units, alpha and beta. And they have book values, including goodwill, of 500,000 for alpha and 75,000 for beta. Alpha reports goodwill of 50. Beta reports goodwill of 75,000. Part of the company's annual review for goodwill impairment. Omega determined that the fair value, including goodwill of alpha and beta, are 48 and 700,000. Now stop. I look at what? I look at beta, and beta has what? has book value, including goodwill, 675, and fair value of what? 700,000. That's the information for beta here. So beta what? Has no impairment. I stop. I don't have to do anything else. I'm done. I don't calculate any impairment for beta because their fair value is more than their book value. I'm done with beta. Okay, now I look at what? I look at alpha here, and alpha got a little bit of a different situation because their book value, alpha's book value is what? 500, but their fair value is what? Is 480. Well, I'm going to take that 20,000 difference and I'm going to write it off as impairment against the what? Against the goodwill, right? Which is 50,000. So I go ahead, I debit the loss due to impairment of 20, and I credit the goodwill. Now, that write-off against the goodwill is capped at 50,000. If another period they come back and they say, well, now there's another 40,000, well, now I'm going to have to start writing that off as impairment against what? Other assets. Goodwill does not go negative. It just goes to 0. Okay. Okay, good. Let's go ahead then and wrap up chapter 4 right now by looking at a couple more multiple choice questions. Okay, guys, coming up on 2 minutes. All right, good. That's right at 2 minutes. I'm going to go ahead and end the poll here. And okay, looks like everybody attempted this one, so thank you. Keep pushing hard on this, guys. The results are that 75% of us got it right. A couple of us chose B, and I see why. Okay, but let's go ahead and see why it's C and not B here. Okay, so you take a look. So that was a good effort on that question. But we take a look, and they tell us that the reporting unit had a book value of 345, including goodwill of 225,000. Now I'm going to go ahead and I'm going to tee up the goodwill. It's not necessary for this question, but I'm going to go ahead and tee it up anyway. There's a goodwill account of 225,000, right? As part of its annual review of goodwill impairment, the entity determined that the fair value of the reporting unit, including the goodwill, was what? 3,310,000. Well, look, if I have book value of 3,450,000 and fair value of 3,310,000, then I have goodwill impairment. So I have impairment here. So I have what? 3,450,000 I have what? That's the book value. I have the fair value of 3,310,000. So I have what? A difference here of, and that difference is the correct answer to this question, 145,000, excuse me, 140,000. So I would debit what? Impairment loss, $140,000. And what do I credit? Goodwill for that 140,000. Now, when I credit the goodwill for the 140,000, I'm thinking the reason that some of you picked 85,000 is that the balance in the goodwill account would be 85,000 at that point, right? But that's not what the question asked me. The question asked me what? What is the goodwill impairment loss to be reported? They're asking me for that number, not the resulting goodwill balance, which is what? This 140,000. Question?
I have a question. So what's the definition of goodwill impairment? Is book value greater than fair market value?
The goodwill impairment is the goodwill impairment is the difference between the book value of the company, including the goodwill, versus the fair value of the company. And if that fair value falls below the book value, the rule is that we will write down the goodwill by that difference. That's the impairment on the goodwill. And we write that down until the goodwill goes to zero. There's no negative goodwill. We do that until the goodwill goes to zero. Then if there was still a difference between book value and fair value, we'd have to start to attribute that to other assets of the company.
Thank you.
Okay. Okay, guys, so at this point, I'm thinking we can go ahead and take the break a little early since we are done with chapter 4. And we can now jump into chapter 5, and I'm going to give you a second to pull your chapter 5. I don't know, maybe you're marking up on the PDF, which is listed there in e-learning. If you're using the 4.1 book, that's fine. Don't worry. There are not significant differences between 4.1 and 4.2 that you need to worry about. So go ahead and continue to use the 4.1 book. And I do have the PDF for 4.2 posted up there at this time. Okay, so I'll give you some time to assemble that information. So why don't we go ahead? We'll take the full 10-minute break here, the full regular break, and we'll come back here at, let's just make it 6:10. Okay, so we're just going to take the break a little early. Okay, guys, I'm gonna go ahead and get it started back, and I forgot to pause the recording. So if you watch this back, you might have to forward through that break there. But what I want to show you here is the point potential for chapter 5. Now, we are still spending time with the balance sheet, and we're going to be dedicated now to the balance sheet as we go through chapter 5, chapter 6, chapter 7. We'll talk about liabilities here, obviously in chapter 5 and chapter 6, and then chapter 7, still on the balance sheet, stockholders' equity, and then we'll talk about the statement of cash flows. That will complete the discussion of for-profit accounting. Then we'll get into not-for-profit accounting, and finally governmental. Now, we are kind of running out of time a little bit here, and so I'm going to take an approach where I'm going to be focusing on the higher point areas on the exam for our time together. And then I will direct you to review information on your own for some of the lower point areas. And that way I'm sure that we'll be able to get to particularly governmental, which is heavy on the financial part of the exam, and a part that I've learned over the years that tends to catch students off guard because it's towards the end of the class, and then we don't spend the sufficient time with it. So I'm going to try to get us there sooner rather than later, so that you are in good shape to get the some 20 to 30 points that can literally come out of when you combine governmental, which is about 20 points, and not-for-profit, which is about 10. Okay, but having said all that, I want to look at the point values here for our discussion in chapter 5, and we can see that payables are listed here, and there's nothing terribly complicated here, guys. That's about 2 or 3 points. We're really talking about accounts payable. Okay, we start talking about various contingent liabilities. Again, the exam doesn't get too far off into that. We're talking about 2 or 3 points. Okay, where the big points are here, and they start calling out long-term liabilities, but what it really is bond payable. Bond payable is a 10-point area every exam since, Newt Becker himself was a boy, okay, had a lot of questions on the Newt Becker, in case you didn't know, is the guy who started CPA review. Newt Becker was working for PwC, was Price Waterhouse at the time, and he's the one that invented, these methods for how to pass a CPA exam. They took them offline, had him in a conference room teaching people how to pass the CPA exam, and then some of the partners at PwC said, kid, you really should dedicate a business towards this. Okay, I think maybe threw him some seed money, whatever, got him going, and the rest is history. Here we are 50 something, almost 60 years later. Okay, so anyway, you take a look, and more than 60 years later, because that was before I was born. I'm 60, so it's probably more like 63 years later. Okay, so anyway, here we are, 10 points, okay, for a bond. So that's where we're going to focus our attention. And we will also go through troubled debt restructuring, because the other thing that I want to do is, even if it is a lower point value, if it has a potential to maybe, have you spend a lot of time trying to understand what the heck's going on, and I can help you through some of that, we'll go through that together. So we're going to look at the second half of chapter 5. But what about the first half of chapter 5? Well, if you look at e-learning, okay, I need to lower this to get back up into e-learning, and hopefully it'll let me back in. Probably won't let me log back in. Hopefully not. Okay. All right, good. You can see here that I have the chapter 5 lecture video still hidden for some strange reason. I'm going to show it now. Okay. And when you look at this chapter 5 lecture video and you look at the start, if you watch that up until, and I'm going to write this here in a second, up until 1:28:09, 1 hour, 28 minutes and 9 seconds, that covers the first half of chapter 5. Okay, so you can watch that, or if you want to, you could watch whoever it is, Alinto or Gary, I don't know who they have doing this. Okay, I suggest you watch my lecture. I'm not objective in that opinion, obviously, but I feel that they spend a lot of time saying, circle this, highlight that, write this down, and don't really ever teach you anything. Okay, where I'm going to actually go through and talk to you about the things over here in this chapter 5, the start part. So let me write that on here, that the time that you will write it is from, that you will watch it is from beginning through 1:28:09, and then the video will pick up where we're going to talk tonight, but there's no sense in you watching that because you're here now, and I'm also going to post up the recording for the end of chapter 4 and this discussion of bonds. Does that make sense, guys? Okay, and I think that that's a better use of our time together. If we were to spend an hour and a half, we'd be at 7:30, we'd be at 8 o'clock, and we still wouldn't have gotten to the heavy point area here, where I think we can knock this stuff out here together now tonight, this heavy point area with the bonds. Okay. Okay, good. So with all that, let me go ahead and put it back to full screen. And let me find my bond payable section. Okay, which starts right here. Okay. And when you look at bond part 1, part 2, there's really no big difference. You know, it's all one subject. Some years back, somebody told Becker, you have to break it down into bite-sized pieces. And so they take, you know, pieces that are really one area and they turn it into 2 areas so that it's bite-sized, whatever that means. Okay, so don't feel like there's some big major shift between what we say in part 1 and part 2. Oh, by the way, if on that lecture that I just showed you, I mentioned IFRS, ignore it. Okay, that was a lecture from a time when IFRS was still on the exam. So if, I'm not sure that it does in that part, but if it does mention IFRS, ignore it. International financial reporting standards are no longer tested on the exam. Okay, I don't think there's any mention of that there. Okay, now let's take a look at bonds. Okay, and I think, you know, you're probably pretty good in bonds. If you took this at GGU, you maybe even took it from me when I talk about bonds in intermediate, what is it, 100B part 2, okay, of 100 of intermediate, okay. And so you're probably in good shape, pretty good shape for it, but some of the things, you know, maybe have left your consciousness a little bit. Let's face it, nobody wakes up in the morning and says, how do you account for bonds? And yet the examiners think it's worth 10 points for you, right? So I think it's worth us to spend some time looking at this together. So first, let's start out with some basic terminology. And I don't know why my machine has gotten into this thing where it's cutting off part of the page all the time. But anyway, let's go ahead and take a look. And we have the face value of the bond. Okay, face value is the total dollar value amount of the bond. They say it's printed on the face of the bond, which of course is a throwback to the 80s when bonds were printed. Now bonds, of course, exist entirely, as do stocks, on a book entry form somewhere. Okay, but if you were picturing a bond, that would be the maturity amount, the total dollar amount of the bond that's going to be reported. Now, you will also have a stated or coupon or nominal rate. I've also seen this called the contract rate, okay? And it is basically contract rate, okay? And it is basically the stated rate. It is sitting there on the bond. Picture a bond, $1 million face, 10% interest rate, okay? Now, the market rate is the rate the interest is actually being earned by the bondholder, okay? And sometimes we'll see that called the yield rate. Okay, now these are just terms, guys. You'll see that sometimes referred to as the yield rate as well. Okay, now if we're in a situation where the market rate is higher than the coupon, the stated rate, then the bond will sell at a discount. If we're in a situation where the market rate is lower than the stated coupon rate, again, synonymous terms, then the bond will issue at a premium. Okay, discount means that the bond is going to be less than face. They'll sell for less than face, and if it's a premium, they'll sell for more than face. Okay, not asking you to flashcard anything, guys, here. I think you know all this, but just a quick, refresher of some terms that we're going to need as we go through the example here. So with all that, let's go ahead and let's take a look at some more terms. The bonds that we're going to really be looking at on the exam are going to be term bonds, something called term bonds. That means they have a term of so many, and it's usually so many years. Okay, so let's just go ahead and let's take a look at this example of this bond right here. Okay, and the bond has $1 million. Let's say this bond was, printed. The $1 million is the face of the bond, as we've talked about. The 10% is the stated / coupon rate. Okay, stated / coupon / contract rate. We've heard it, you'll hear it called different things. They're not consistent what they call it. The number of years is the term of the term bond. Semi-annual means that it has how many payments per year? 2 payments. That's pretty common for these questions. You'll see, for example, in this bond we're going to be studying here, the payments are June 30th and December 31st. Some bonds only have 1 payment. It could be, triennial, or there'll be 3 payments, but or 4 payments, maybe they pay quarterly. But you're going to see, for the most part on the CPA exam, it's going to be semi-annual, 2 payments. Okay, now when we look at this question now, okay, let's look at the situation. Okay, what I really want to focus on is when bonds are issued at a discount versus a premium. Okay, now when we look at this bond, they tell us that there's a yield or market rate of 12%. The bond that we just kind of reviewed has has a face amount of $1 million, a stated coupon rate of 10%, and it's 5 years. Now let me ask you, is this bond going to issue at a discount or a premium? Ruin the story. That's like a movie that has a headline that says, a title that says the hero dies. It's going to issue at a discount. Why? Because the coupon stated rate is less than the market rate, right? So no one's going to pay full face amount for this bond, because the bond's only giving them a 10% return, when the market is saying, hey, for a bond like this, you should be getting what? A 12% return. Okay. Now, when you look at all these factors they give us, because we're going to have to figure out how much should somebody pay today for the right to receive what? To receive the principal, the $1 million back in this 5 years, and what? And semi-annual interest payments of a certain amount. They're going to come out every 6 months on this bond. And so to figure out that present value, we have to figure out the amount of interest and then the correct periods to discount both the principal and the interest. So the way we will figure out the amount of interest payments is we'll take the face of the bond. We pick up what? We pick up the coupon rate, which in this example is what? 10%. But since it's semi-annual, we have to what? Multiply that by 1/2. And so this bond is going to pay $50,000 per every what? Every 6 months for 5 years. So it'll pay what? It'll make the first interest payment on 6/30, the second one on 12/31 of year one, 50,000, 50,000. And when you count up these 50,000s, which don't change from period to period, that's the contract. That's why they sometimes call it the contract rate. There will be what? 10 payments of 50,000, right? And then at the end of those, what? Of those 10 semi-annual periods on the same day as that last interest payment, the principal will be paid back. So we have what? We have 10 periods we have to deal with here, don't we? 10 periods, 10 semi-annual periods. Now, since they tell us that the yield rate is 12%, we have to take that 12% and do what? Divide it by 2. Just like we took the coupon rate and divided it by 2, we take what? We take the yield rate divided by 2. So we have to discount this over 10 periods at what? At 6%. So now that I understand that, I'm able to do what? I'm able to come up with the present value of $1, 6% for 10 periods. This is that 0.558395. Okay, that's for what? That's for the principal, isn't it? It's a one-time payment, present value of $1. That's a one-time payment. So I picked that up for the principal. And then for what? For the interest, I have to pick up the present value of annuity at 6% for 10 periods. So all this other stuff is just in the way, isn't it? And the exam might do that. They might give you a few factors to choose from. You have to know which ones to parse out. The what? The present value of annuity is for the interest, right? And then, as you know, an annuity is a stream of payments, and that's what we got here. We got 50,000s for what? For the next 10 semi-annual periods over the next 5 years, every 6 months. And then we've got just what? Just one payment of the principal. Question. Okay, now that we know the correct factors to pick up, now we can go ahead and we can calculate the present value, and let's do the present value of the principal first. And we pick up that $1 million principal, and we go ahead and multiply it by that factor up there for the principal, and that gives us the present value of the principal. And you can do it in either order. I don't know why I like to do the principal first. Then we go ahead and we do what? We pick up the present value of the interest. We add those two together, okay, picking up the present value of the interest using the present value of the annuity factor. And that means that somebody is willing to pay $926,399 for the right to receive what? 10 payments over the next 5 years, 10 payments of what? 50,000, and then of course the return of their principal at the end of that 10 semi-annual periods, right? Now, why are they willing to pay? Why are they going to only pay less than face? Because they're wanting a yield of what? 12%, when this bond's really only paying them 10%, right? So they're not going to pay full price. The extra what? 70, what does it come out to here, guys? 73,601, the difference between the million and the 926,399, that will catch them up at the end of this thing, because we're going to pay back the full million, won't we? That's going to catch them up at the end of this thing for all that time that they were receiving a 10% return when the market wanted what? A 12% return. So when we go ahead and we issue this bond, we go ahead and make that journal entry. We're going to receive $926,399 of cash. We're going to credit what? Credit the bond payable, and now they'll debit this discount 73,601, which is the difference between the face and the amount of cash we got. Question. Now, we will talk about the investor, but not right now. We'll get to that investor piece later. And they could have talked about this in F4, but they decided to wait till now to talk about how to account for investment in bonds, the actual mechanics of it. Okay. Okay, good. Now, if a bond issues at a premium, it's going to be issued for more than face, right? And that's because now the coupon stated rate is what? Is more than the market rate. Okay, so we know it's that same bond that has the 10% coupon rate, $1 million face, 5-year term, and the semi-annual interest dates are June 30th and December 31st. And now they tell us, market yield rate is what? 8%. Okay, so now what am I going to do? Well, is the 50,000 going to change? No, that's in the contract. So you won't change the amount of the semi-annual interest payments just because the market rate changes. That 50,000 will not change. Just think of this 50,000 in this example like your best friend. You say, promise me you'll never change. Okay, I'll never change. Okay, so it's not going to change. It's going to stay 50,000 every 6 months for the next, 10 semi-annual periods. What has changed here, though, is what? Is the market rate. By the way, guys, sometimes I get this question. I'm not sure why, but some students will say to me, so every CPA exam question, it's going to be 50,000? No, I'm saying for this bond, it's 50,000, right? Okay. Now, 8% what? Divided by 2 gives me a semi-annual market rate of 4%. We still have the 10 periods. So now I have to come and find what? Find the present value of $1 at 4% for 4 periods. That's for what? That's for the principal. For the interest, right, I'm going to pick up the present value of the annuity at 4% for 10 periods. That's for the interest. The rest of this is what? Is distractor. Okay. Okay, good. Now I come over and now I just do the math. And when we do the math here for the principal, I like to do the principal first. When we do the math for the principal, it's the million times that factor. That's the present value of the principal. Present value of the interest is the 50,000 times that factor we found. And we add those together. That now gives me the issue price of this bond. Okay, now they're willing to pay $1,081,109 on this. Meanwhile, when we return the principal, we're only going to return what? $1 million. So we get to keep an extra $81,109. Why? We get to keep that because our bond is paying 10% when the market for a bond like this was only requiring what? An 8% return. So the bond issued for more than face. We'll deal with the investor side later. Question. Okay, good. Now you come over and let's just review some of the things that we've really already talked about, but let's look at this since this is here. Okay, stated interest rate. The stated interest rate of the bond does not change regardless of the market rate. Okay, the amount of cash will stay the same regardless. And so in our little example, the stated rate was what? 10%. And don't get confused, guys. Sometimes they call it coupon rate. Sometimes they'll call it contract rate. Okay. The effective interest, otherwise known as what? The market rate. Sometimes they'll call it what? The yield on the bonds. Okay. And in our little example, that market rate was what? Was 12% for the discount bond and what? 8% for the premium bond? That's percent, 12%, 8%. Okay. Now you come over and what discounts, and they tell us that if the market rate of interest is higher than the stated rate of interest, the bond will sell at a discount. So we had the situation where the market rate was 12%. The coupon rate was 10%. So the market rate, right, was higher than the stated rate. So the bond sold at that discounted price, less than face. Okay. Now, the way you will show that, and you can go ahead and flashcard that, guys, in case you're needing to remember that, you know, it doesn't seem that obvious to you. Okay, you can go ahead and flashcard that. But then unamortized discount, the unamortized discount, the bond payable is a contra account to the payable. Okay, which means that it is presented on the balance sheet as a direct reduction from the face. So right after issue, in our long-time liability section of our balance sheet, we will show what? The $1 million face minus the unamortized discount. And immediately after issue, the unamortized discount is what? Is the total amount of discount we calculated. Now we're going to amortize that. And as we amortize that, as we make it less, the carrying amount is going to go up, right? Okay. Now you take a look at the premium, and for the premium now, let's just look at that. If the market rate of interest is lower than the stated rate on the bond will sell at a premium. That means it will sell for more than face. So now we had what? We had the market rate was 8%, I think, and that was less than the stated rate, which is the same regardless of what happens with the market, right, of 10%. Okay, just relating this back to our example. Now, when we deal with the unamortized premium on the bond is presented on the balance sheet as a direct addition to the face. And I've had students ask me, well, is that an anti-contra? I mean, is there a word for that? And the word is adjunct. If an account balance adds on to another account balance, that account balance is called an adjunct because it's adding on. Okay, but that's probably beyond what you need to worry about. But contra means what? It's against, it's going to lower the account balance. Adjunct means that it adds on. Okay, and so it's add it on. And so you can see in the long-term liability what happens. In the long-term liability, we reported $1 million in the long-term liability section of the balance sheet. We add on the unamortized premium, and immediately after issue of that bond, it would be what? This $1,081,109. Now, what'll happen is what? As we amortize the premium, of course, the premium will come down. The carrying amount of the bond will come down. Okay, so why don't you go ahead and flashcard this right here if you need to, and it's one or the other. To the carrying value of a bond is going to be face plus the unamortized premium, or it can't be both, face minus the unamortized discount. It's one or the other. Okay, question. Okay, good. Now, bond issue cost, what happens? When you go to issue a bond, you're going to have to pay some cost out. If you have to pay some cost out, what's going to happen? You're going to get less cash back when you issue the bonds, aren't you? You're going to have to pay underwriters. Let's just take a look at some of these bond issue costs. You're going to have to pay underwriters, accounting fees, legal fees. I'm not going to highlight printing because these days they don't really print the bonds, but whatever. These are bond issue costs. So what happens? That means that when you issue the bond, you're going to receive less cash on the issue of that bond because you're having to pay bond issue costs. The underwriters are going to take their cut, right? So if you're going to get less cash, then that's treated as though the bond has sold at a discount. You're going to basically deepen the discount. Or if it was a premium, you'll lessen the premium. You'll take the premium away and create a discount for whatever you have to pay for these bond issue costs. So bond issue costs are presented on the balance sheet as a direct reduction of the carrying amount of the bond, similar to a discount. Okay, flashcard that. Okay. When the bonds are issued, the bond proceeds are recorded net of the bond issue cost, and bond issue costs are amortized as interest expense over the life of the bond using the effective interest method. In other words, as we amortize the discount, in that discount will be rolled in the bond issue cost, and we'll amortize that using the effective interest method, which we're going to talk about amortization here in a couple of seconds. Okay, but let's just go ahead and take a look at this example as to how the bond issue cost will make the discount more. And notice, guys, I'm not going to repeat everything here. It's the discount bond. The bond sold for $926,399 because the market rate was 12 when the coupon stated rate was 10, same bond. So we would have got what? If it weren't for the bond issue cost, we would have gotten that full, what was the amount that we would have gotten? $926,399 right there. $926,399. But I don't know why I'm writing that again. But what happens? We have to pay bond issue cost of what? $20,000. So maybe that's why I'm writing it. So if you take the $926,399 and you subtract the 20,000, I guess it's necessary for me to write that. I don't know. You get this number, don't you? That's the amount of cash we netted out on the issuance. Okay. What happens? Bond payable is always recorded at the face, because remember, we're going to show the face minus the discounter plus the premium. So we got to credit the bond payable for the face. And then the discount is going to be what? It was $73,601 before we had to consider these bond issue costs. But once you add those, now the discount is what? $93,601. Okay. And so now we'll sit here and we'll have what? We'll have this discount that's deeper, and that will now create a carrying amount of the bond that has been decreased by these bond issue costs. And then we will amortize that entire discount, including the bond issue cost, using the effective interest method, which we're going to be talking about here in a couple seconds. Okay. Okay, good. What are they doing to me here? Did they change something on me here? No, we're good. Okay. Let's come down and take a look at deferred bond issue cost. We'll deal with amortization in part 2. So don't worry about the amortization right now. I'll show you how that works in part 2. Okay, now of this bond payable section. Now you come over, and bond issue costs incurred before the issuance of the bond are deferred on the balance sheet until the bond liability is recorded. So why don't you go ahead and flashcard that? And I feel like this is much ado about nothing, but just in case the examiners, tell you that there were bond issue costs of $20,000, but they weren't going to be paid until later, then what would happen is you would debit this deferred bond issue cost of 20, credit the cash of 20 if you had to pay that before you actually issued the bonds. And then when you issue the bonds, then you can go ahead and credit that deferred bond issue cost. And since you all had paid that up front, of course, now you'll get the full amount of cash. The discount is still what? Is still inclusive of that 93,000, of that 20,000. So it's still 93,601. And of course, we always credit the bond payable at $1 million. Question? Okay. If there's no question, then let's go ahead and let's take a look at, oops, what am I doing here? Take a look at this first question for our new chapter here. Okay, guys, that's about 2 minutes on this question, so I'm going to go ahead and end the poll. And looks like most of us had a chance to get this correct, which is 91%. And it's just really asking you, do you understand the mechanics as to how to come up with the amount that a bond should be issued for? And it is what? It is the present value of the principal and what? All future interest payments at the effective or market rate of interest. That almost literally comes right out of what we saw in the book, right? Okay, now this question number 2, I don't agree with their placement of it here, because it starts talking about amortizing a discount in this particular case. Meanwhile, we haven't really talked about that yet. Okay, so I don't want to, I'm not sure why they put it here, because our pattern is what? We review, we look at a question, we review, we look at a question. Why are they giving me a question and then I'm going to review? Now we've thrown off the whole system here now. So I don't want to do it now. If I forget, Serena, maybe somebody, pick on Serena, but somebody, Nina or somebody, or Michael, or Alan, picking on the people with their camera on, remind me, okay, hey, I want to look at that question 00470, question 2, because it is a good question, but it's I don't like the timing right now. Okay. All right, good. So let's just come over, going past that for now. And let's come over and let's look at now the amortization. And again, all one big subject. The fact that they put this in a second module, or this part 2, really does not, it's still all the 10 points. Okay, so we have to amortize that premium or discount that we would have, and of course it has to be one or the other. And so let's just take a look. And we say that under US GAAP, the period over which to amortize bond premium or discount and bond issue costs is the period that the bonds are outstanding, which is from the date the bonds are sold. Okay. Now, you take a look, and it's a 5-year bond. 5 years is 60 months. But if they don't issue the bonds until November, be careful, guys. When you're thinking about months on the CPA exam, count on your fingers, because it's very easy to mess up, say November. Well, that's 11 months. No, it's November 1st. So it's what? January, February, March, April, May, June, July, August, September, October. Don't count November because it hasn't happened yet, right? So that's 10 months. So that means that those bonds are actually only outstanding for what? For 50 months. And so you would have to use that period to amortize the premium or the discount. And of course, that is really only truly important if we're using the straight line method. Okay, so let's just take a look and see how we will amortize the premium or discount. It's one or the other. And so we put the premium or discount in the numerator, and then we would go ahead and put the number of periods the bond is outstanding on the denominator, and that becomes the period that we will amortize. And again, it's the period outstanding. Did I tell you a flashcard that? It's the period outstanding. Okay, now, if the bonds are issued, at a date after the start of the year, even if you're using the effective method, I want to clarify something. You would only use the effective interest rate, the market rate of interest, for what that fraction of the year that the bonds were actually outstanding, right? Okay, but that's a little more straightforward, I think. And we'll look at some questions where we do that. Now, you come over and let's take a look, and I want you to flashcard this. And then let's see how we will do the effective interest, the interest expense using the straight line. And you can go ahead and, you don't have to flashcard this. Interest expense is going to be what? Interest expense is going to be the face times the stated interest. So for our bond, that would be what? 1 million times what? 10% times 1/2, or what? 50,000. And then we'll adjust that by what? By subtracting the premium, it has to be one or the other, or by adding the amortization of the discount and bond issue cost. So it's either going to be less than 50,000 or more than 50,000, right? When the bond issue is at a discount or premium. Okay, so let's just go ahead and let's practice with this. Okay, now again, we have this bond, and now they've, decided to not think about the bond issue cost, which is fine. Million minus it issued for 926,399. So we have what? 73,601 is the premium, the discount here, and we divide that by 10. So we're going to take a equal amount of amortization on this discount each period. Now, notice that we do what? We take the amount of the amortization of the discount, we add that 50,000 is my best friend, it won't change. That gives me what? 57,360.10, that's the interest. Okay, then what? Then I'll take the 926 $399, and I will add $7,360.10 to it. That gives me 933,759.10. That number right there. So you add the what? You add the discount amortization to the previous carrying amount, thus bringing the carrying amount what? Up. And it makes sense that it has to come up because the day is coming where we will eventually have to pay what? Eventually have to pay $1 million on this bond, right? Okay. So as you look at this, notice we made that entry we already saw when we issued the bond. And if you were to kind of tee up the discount here somewhere. Okay. If you were to tee up the discount, we originally did what? Debited it for 63,601. And then through this straight line amortization, we just did what? We credited it for $7,360.10. Okay. So if we were to go ahead and prepare the balance sheet after we have made this journal entry right here, there's that credit. They're paying out the 50,000 cash. We debit the interest expense, 57,360, because we had the 50,000 and we added the discount amortization here, right? And so what happens, the balance sheet would look like this, right? The balance sheet would have bond payable, still $1 million. But now the discount is showing, and the discount would now be showing what? If I'm doing my math right, is it now showing 66,244.50? Right? 66,244.50 because I credited the discount there. And so if I report the discount immediately after that first interest payment, now the discount is sitting there at 66,244.50. That means that the carrying value of the bond, and I already know it because of what I did up here, is 933,759.10. What is it? 933, what? 755, not 10, but 50. What's happening? 933,759. Why am I writing 50 in one place and 10 in the other? So this should be what? This should be, did this cents wrong. 73,601 minus $7,360.10 is 6244. Is it 50 or 90? Is it 90? Come on, guys, help me out here. You know what I'm trying to do. 73,000.
90. 90. 7.
24490.
Yes.
Thank you. 24490 makes this what? 10, not 50 cents. Okay. Okay, good. Pen to fix that in my book, but I can't find a pen, so I'll make that same mistake next year. 1 second. Okay, good. All right, so that's what that would look like. There would be that 10 cents, okay? And that's the carrying value. You can see that what? As we move through, the carrying value of the what? Of the bond comes up because eventually it's going to mature at $1 million, isn't it? Okay, so that observation now yields us, I think, a useful flashcard that I want you to put right here. Okay, and I'm going to call out the flashcard to you. I'm just going to speak it out to you and just go ahead and I'm not going to write it. You're just going to write it down as I speak it. Okay, ready? So the flashcard, the question side will say, what effect will discount amortization have on interest expense and carrying value of bonds? What effect will discount amortization have on interest expense and carrying value of bonds? And the answer is what? It's going to increase them both, isn't it? It's going to increase the interest above the cash interest, and it's going to increase the carrying value of the bond, isn't it? Okay, so now if you have a question, and they might do this to you, they'll simply say, here was the carrying value, and here was the discount amortization. What's the new carrying value? You simply do what? And usually that's how they ask you straight line. They're not going to just come out and say, what's the amortization on the discount under straight line? Because that's too easy. You just take the what? You just take the discount and you divide that by the period the bonds are outstanding. That's too easy, right? They're going to then ask you to do something with that discount amortization. And it's going to be what? Either give them the interest expense or the new carrying value, and you simply add it to the cash interest. You simply add it to the previous carrying value to get the new carrying value, right? Okay. Okay, good. Now you come over, we'll get to the investment side later. Okay, and now we have the premium bond. Okay, and there's the straight line amortization. They divided it by 10 periods because these bonds were issued on January 1st, so they were the full 10 semi-annual periods. So that's the amount of the straight line amortization now of the premium. And now what happens? Now the premium is subtracted off of the 50,000 to get the interest expense, because what? because we're going to get to keep an extra 81,000, whatever it is, 110, whatever that amount is, 81,109, aren't we? We're going to get to keep that. Okay, so our interest really isn't 50,000, it's an amount less. Notice that we do what? We take the 1,081,109. We subtract what? We subtract the amortization of the premium now. And that gives us what? That gives us the new carrying value, doesn't it? Okay. Now, if we were to go ahead and do an analogous thing that we did before with the discount, now we do this with the premium. And when we issued the bond, we credited it for 81,109. We just debited it for 8,110.90. And I'm not going to trust my earlier calculations because I think I was using different iteration of the book. It should be, well, I can peek and look at it here. It's now what, 72,998.10. Right? Did I do my math right? It's now 72,998.10. And so when I prepare the balance sheet after that first interest payment, the bond payable is how much? It's going to be the face. The what? The premium now is this 72,998.10. So now the carrying amount of the bond is this 1,072,998.10, and it's coming down. And it should come down because what? I'm going to only have to pay back $1 million. Right now it's up over $1 million. I got to bring it down over these 10 semi-annual periods to that lesser amount of 1 million. Okay, so let's go ahead and let's just stay consistent. Let's do a flashcard over here somewhere. And now this flashcard will be, what effect does premium amortization have on carrying value of bond and interest expense? And the answer is it decreases both of them. What effect does premium amortization have on interest expense and carrying value of the bond? Answer is it decreases both of them. Because again, they may give you a question which they're making you use the straight line method to amortize a premium or discount, but what? It's not going to stop there. It's going to then make you figure out the interest expense or the carrying value of the bond after that. And you simply what? You'd simply subtract it from whatever the cash interest is. You would simply subtract it from the previous carrying value, right? Okay. Okay, good. Now you come over and effective interest method. Now, they tell us that the effective interest method is required by US GAAP. Okay, you know, they tell us that you can use straight line if it's not materially different from effective, which I find very annoying because you have to first figure it out using effective to see if it is materially different from straight line. And by the time you've done that, you might as well use the effective. Okay, but that's what is required by US GAAP. But if it's not different, that much different than straight line, then you could probably get away with straight line. But for the CPA exam purposes, you got to know straight line. Okay, but let's just take a look and let's see how we'll calculate the interest expense using now the effective interest method. And with the effective interest method now, you take the carrying value of the bond at the beginning of the period, multiply it by that effective market, what else have we called that? Yield rate, whatever it is, okay? That's the interest expense. Then to figure out the amortization of the discount or premium, amortization of the discount is we'll take the interest expense minus the interest payment. In our little example, that interest payment is what? 50,000. It's going to be the million times the 10% times 1/2. The 50, what does your best friend say? I'll never change. That 50,000 does not change. The stated coupon interest that's paid does not change. Okay, so it's going to be, again, when I say, I don't know why I get that question sometimes. Every CPA exam is going to be 50,000. I think someone's just messing with me when they ask me that. No, whatever the face times the coupon rate of interest, if it's a semi-annual bond, which they often are, times 1/2, whatever, is the way you'll calculate that. That won't change. Oops. Except I messed it up and wrote it in the wrong place. 50,000, that doesn't change. Okay, whether it's a premium or a discount bond. So if it's a discount bond, the interest expense that we just calculated, what? Right there. Okay, which I guess I put it over here. Okay, and then what? We look at the interest payment, that's that 50,000. If it's a premium bond, again, it's the what? It's the carrying amount of the bond times the market yield rate of interest gives me what? Gives me the interest expense. And then the amortization of the premium will be the difference between that interest expense and the interest payment of 50,000 in this case won't change. Okay, so flashcard both of those. And then come over and let's just take a look at this Christie Corp example again. And this time they start us with the premium. The bond issued, guys, same bond for 1,081,109. Same example. The semi-annual interest amount is 8%, what? Divided by 2 or 1/2. So we got to use the 4%. We multiply that times 4%. That gives me the effective interest. There's my buddy 50,000 is not going to change. That difference gives me the amortization of the premium of 6,756. I go ahead and I subtract that amortization from the what? From the previous carrying value. That gives me the new carrying value. I know that the premium amortization is always going to reduce the carrying value. That doesn't change because we have a effective interest method now versus straight line, right? It still reduced it, didn't it? I subtract the premium amortization from the previous carrying amount. I bring the new carrying amount over. I multiply that times 4%. That gives me the interest for the next 6 months. I compare that to the 50,000. That difference now gives me what? Gives me this 7,026. I subtract that from the previous carrying value. That gives me the new carrying value. I bring the new carrying value over now for the next 6 months. Get it over here, times the 4%, and so on. I'm not going to go through the whole table with you. You should be able to go through this entire table, understand what's going on, because I have seen CPA exam release questions in which they ask the candidate to do just this. It's maybe 5 semi-annual periods or maybe 5 years because they don't want to see if you can grind through 10 years of this. Maybe they'll do 3 years or something like that, but they do expect you to understand the mechanics of this. You should be very, very, very good at this come exam day. Question. Okay. Journal entries don't change, guys. It's the same thing with the journal entries, just different numbers because we use effective interest method versus the straight line. Okay. Okay, good. Let's do the, I started this. Let's do the discount. Okay, now again, it's the discount bond, right? That issued for $926,399. But the mechanics don't really change in terms of calculating the interest expense, which is what? $926,399. The market rate of interest was 12%. divided by 2 gives me semi-annual 6% times the carrying amount of the bond at the beginning. That gives me the effective interest versus the 50,000. Guys, notice it doesn't change because we're using effective. The amortization of the discount is going to do what? The interest expense is going to be more than the face amount of interest, right? For the discount bond, it was less than the face amount of interest for the premium bond, right? Okay, that's the same. Then we have that difference. We take that difference and we do what? We add it to the previous carrying amount to get the new carrying amount, right? When we add it, we take that new carrying amount, we bring it over, times the 6% gives me the interest for that next semi-annual period. That difference is the amortization. We do what? We add it to the previous carrying amount. That gives me the new carrying amount. I bring that over. I'm not sure if I'm drawing my lines very well, but I bring that over, right? And I multiply that times the 6%. I'm not going to go through the whole table. You should go through the whole table. You should be very, very good at this because it could be a premium, could be a discount bond. They may have side by side a premium and a discount bond and expect you to be able to amortize it using the effective interest method. The journal entry doesn't change. The flashcard that we made doesn't change. The amortization of discount increases the interest above the interest payment, doesn't it? Even though we're using the effective method now. And the what? The discount amortization increases the carrying value of the bond. That doesn't change just because we went from effective to from straight line to effective. Okay. Now can I show you the investor? Okay, I'm going to show you the investor. I didn't want to do the investor every single time because we're really focusing on the bond liability, but you will see some questions in your homework where they'll focus on the investor. And when the investor invests in the bond, they don't talk about discount or premium. They simply record the investment at whatever they paid for it. And then they take the 926,399, which is what they paid, and they multiply that times what? And for the premium bond, it was 0.06. I mean, for the discount bond, it was 0.06. Check my math. Does that give me 55,000, roughly 55,584? I think it's 55,583.70 or something stupid like that, but pretty close to 55,584. It's a little bit of rounding.
Yeah,
Right?
55,580.94.
580 or 583?
583.94.
583.94. Okay, close enough. Okay, so it's
I transposed a number.
I did?
No, I did in my
Oh.
calculation.
Okay, no, that's fine. Yeah. There used to be a penny mistake in here that used to drive me nuts, but they fixed it now. So, okay. So anyway, 55,583.94. Okay, good. So that's close enough. So what happens? That becomes my what? My interest revenue. And I debit the investment in the bond. Now, if the investment initially had what? Let's call it bond investment. If the investment initially had this 926,399, and I just debited it for what? 5,584. Help me out, guys. What's the balance in there now? 926,399 plus 5,584.
31,983. 1,983.
983, you say?
Mhm.
Okay, good. And so if they ask me the interest revenue for the second 6 months, I'd do what? I'd pick that up and I'd multiply that times what? 0.06, and that gives me the interest revenue for the next 6 months, whatever that comes out to. What's that?
55918,
55918,
18 and 98 cents.
919 roughly, which is what they got right there.
Yes.
And then that gets added and so on. Now, remember, guys, if this bond was a available for sale bond, I would then also have to compare that carrying amount to what? To available for sale or a trading bond. Then I'd still have to compare that to the market value and adjust it accordingly that way. I would still amortize what? I would still amortize the interest revenue this way, but the actual carrying amount of the bond could fluctuate depending if it's a held to maturity, that's what we meant by amortized cost is this right here, right? But if it's a trading or available for sale, then I'd have to market to market each period after this. And that would be either if it's trading, that difference would go to the income statement. If it's a available for sale, that would be part of my other comprehensive income on unrealized loss on an available for sale debt security, right? Question? Okay, good. Now you come over and did I hear something? The hell is this? Including bond issue cost. Oh, we don't need to worry. Don't worry about this. It's just going to make the change the interest rate on it. And you don't have to worry about trying to calculate the different interest rate here. The exam would give that to you as to what the new interest rate is because of the bond issue cost, and then you would use that to amortize it. You don't have to calculate that. Okay, good. Okay, now bonds issued between interest payment dates. What happens? Even though the bonds are issued are dated, say January 1st, the company may not issue those until sometime later in the year. When that's the case, then, or they may issue some of the bonds at January 1st, and some of the bonds they might issue later on. Well, that could create what? That could create an accounting nightmare for them, because what would happen? They'd have to cut a different amount of a check for everybody when it came to pay the interest, right? So what they want to do is they want to be able to cut a check for everyone for $50,000 at that interest payment date. So what they do is, as each person comes up and buys that bond, what they do is they make that person give them the interest that is accrued since the last interest payment date to the date of issuance. They collect that cash up front. They set that up as an interest payable. And then when it comes time to pay the bond, they do what? They pay the interest, I should say. They do what? They pay everybody $50,000, and it makes their accounting much easier than saying, well, let me pay Nina this much, let me pay Serena this much, let me pay Michael that much. Everybody gets $50,000, right? It's much easier to figure the accrued interest upon each issuance. Okay, so in this particular case, now coming back, and what I want you to write here. Oh, yeah, I'll go back to that. Turn my pages too quick. Yeah, I want you to flashcard that when we issue bonds are sold between interest date requires entries for accrued interest at the time of sale. I want you to flashcard that, but I want you to put on there as your little hint here, more cash on issuance. It's going to result in more cash on issuance, okay? Now what happens? In this example, they tell me that on April 1st, they issued 10% bonds to January 1st, year one, the face amount $1 million, and they issue for 926,399. So if I'm given that information on the exam, I know 926,399 is part of this answer, right? Okay, but I know that whatever the accrued interest is going to increase the amount, right? Okay, so the way I will figure out the accrued interest, since bonds were dated January 1st, and they're not issuing them until April 1st, I have to do what? I have to count January, February, March. That's 3 months of interest accrued while those bonds sat on the shelf. So I take the million times the 10% times 3/12, that's 25,000, right? So the company is going to get 951,399. Okay. The discount amount is still the same. We always credit the bond payable for the face. And guys, let's not confuse ourselves with reversing entries right now. Just credit bond interest payable for 25,000. I'll show you what they're trying to do with that expense in a minute, but this is a very sloppy way of trying to introduce reversing entries right here when we're kind of, trying to understand the accrued interest, okay, on this bond. So we will go ahead and do what? We'll credit bond interest payable, and that's the bond interest payable for what? January, February, March, while those bonds sat on the shelf, right? Okay. Then what happens? Then on June 30th, what's your best friend's name? One time I taught this class and the person said Steve. Okay, my best friend's name is what? 50,000. So I credit cash for 50,000. I do what? I debit bond interest. And again, let's just not confuse ourselves. I debit the bond interest payable 25,000. That's for January, February, March, right? Because I'm giving them their money back. They gave me this 25,000. I held it, and then I'm going to do what? I'm going to give it back to them on the interest payment day, right? And I do this for an accounting efficiency, right? And then we're going to have to squeeze in here. I will debit bond interest expense. And that is expense for 25,000. That's now for what? That's now for April, May, and June, isn't it? That really is interest expense, because now we got to use that cash for those 3 months. So we got to pay the interest on that, right? And that is an interest expense. Okay. Now, that reversing entry nonsense that they were trying to show us, okay? Let's say we followed that interest expense thing. They told us to credit interest expense for 25,000. I kind of crossed that out, but they wanted us to possibly consider crediting interest expense. And then when the bond comes due, they're going to do what? They'll debit interest expense for the full 50,000 and credit the cash for the 50,000 they're going to pay. With me so far? Okay. And when they do what? When they debit the interest expense for 50,000, the net interest expense it's going to show is 25,000. That's called reversing entries. You can do that, I guess. Some companies, some CPA exam might contemplate, CPA exam question might contemplate that. I don't think so, but that's what that was about. And of course, they're completely ignoring what here? The amortization of the discount. Okay. Now, you need to be careful, because if you're in a situation, okay, where the bonds don't pay everything within the year, and in this example, now they're not paying that interest until what? Instead of December 31st, they're paying it into January the next year. Well, that means that what? At December 31st, don't forget to be a good little full accrual accountant and do what? Amortize your interest expense at the end of the year, okay, which is going to be what? The 50,000 plus the amortization of the discount, which we saw before from our calculations earlier was 5,919. The amortization of discount increased the interest expense. You still credit the discount just like you would if you're paying the cash. So the only difference is what? Instead of crediting cash, you're going to credit interest payable, and then presumably the next day you would debit the interest payable and credit the cash. Question. Okay, so I want to go back now to that question that I said it was too early before. Oops, I should just take full screen. Full screen. Try to find that earlier question.
Page 43.
Thank you. Okay, good. So now let's do this one. Now I think we're fully equipped to do a good job on this question, okay? Okay, guys, I gave you a full 3 minutes. We got about 3 folks that maybe are a little stumped with this question. Okay, good, maybe a couple folks, but everyone who did it did get it correct. So that's great, okay, because you will absolutely see questions like this on the exam, okay? So let's just go ahead and let's just take a look at this one. And they tell us that on January 2nd, year one, West Company issued 9% bonds in the amount of 500,000. Now that is what 9% is the coupon rate, 500,000 is the face, right? Which mature on January 2nd, year 11. The bonds were issued, it doesn't say, but we know they're issued at a discount to yield what? 10%. And that makes sense because what? The market yield rate is 10 and the coupon stated rate is 9. And so we know this bond's going to issue at a discount. Interest is payable annually on January 31st. Wes uses the effective interest method we're going to have to use. And in June 30th, year one. Now, what would be the carrying amount? Now you look at this question and it's a little bit confusing because it's what? It's an annual bond, but then they're asking you what's the carrying amount after what? After 6 months. So in effect, you can use what we learned in the book about what amortizing a discount on a semi-annual basis, right? Okay. Now let's say you're looking at this question and you're like, well, I've spent 2.5 minutes on this. John told me not to spend more than 3. I'm a little confused here. How can I cut my losses and move on to the next question? Well, look, there's no way that 6 months later, the carrying amount is the same. We know that the carrying amount has to do what? Has to go up, right? For discount amortization. But after 6 months, it can't go all the way up to the 500,000. Okay. Now they say, what should we report as bond payable? And you might say, well, John, the bond payable account's always got the face amount in there, right? But there's no, just read all the above and then turn in your paper without filling out anything kind of answers on the CPA exam. So don't think it's that. Okay. So you see something like that, you're like, well, I'm not going to just jump to that 500,000. The answer is either B or C. And if I'm looking at this, if one of the amounts caused it to go down, I'm done. Unfortunately, both of those amounts did what? Caused it to go up. And so I have to do some work here now. So the way I like to do this is the way the book taught us. I take what? I take that 469,500. I multiply it by the market yield rate of interest of 10%. But since they're asking me at 6 months later, I multiply that times what? 1/2, and that gives me 6 months interest expense of 23,475, right? Then the what? The amount of 6 months cash interest that would have been set up had I actually been paying it at that point would be the 500,000 times what? 0.09 times 1/2 gives me what? 22,500. Now, when you look at that difference, that's a difference of what? 975. What am I supposed to do with discount amortization? I do what? I add it to the previous carrying amount, don't I? Of 469,500. That was on our flashcard. And when I add that, I get what? I get this for, which one was it? 470,475. B. Question? Okay, good. All right, now we can go back. There's no question on that. What page were we on, Michael, for before?
56.
56, thank you. Okay, good. Let's go ahead and let's do that question now. Question 1 here. that's the 2-minute mark. I'll give you more time, but you really should be able to answer a question like this in 2 minutes. Okay, guys, looks like most of us, a couple of us are maybe having a little trouble with this one, but let's go ahead and take a look at this. And yeah, we got a good 90% on this one, so that's good. I think that once you kind of get a little more comfortable with these questions, you'll see that these are pretty easy. What might have been messing some of us up is I don't know that we really told you how to handle information like this during the discussion here, but it's pretty easy in that if you have 600 bonds and they are $1,000 each, you're going to take that 600 times 1,000. That means that the total issue here is 600,000, right? Now, if they tell us that it's at 99, and that's what might have stumped some of us, then you have to multiply that times 0.99. In other words, they're telling you it's not 100%, it's less than face. If it goes over 100%, they said they issued them at 102, then that'd be 1.02 would be the calculation, okay? So if you take that 600,000 times the 0.99, you get this 594,000, okay? Now you look and they say the bonds are issued on July 1st, but they were dated what? April 1st. So that means those bonds sat on the shelf, what? April, May, and June, right? So since we've got accrued interest for 3 months, we know, and that's what I had you put on the flashcard, that the bonds have to issue for more. I'm going to get more cash, right, out of this. Okay, so we know right out of the gate that what? B is wrong. Okay, then I'm going to sit there and I'm going to say, okay, but I got to figure out the accrued interest. So if it's 600,000, interest rate is what? 10%. And the bonds sat there and accrued interest for what? April, May, June. That's 3 months, isn't it? So I multiply that times what? Times 3/12. That gives me 15,000. So the answer is what? 609, which most of us got. I gave you 2 minutes on this. Question like this, you should be able to work in a minute on the exam. You should get very good at this. Question? Okay, good. Let's take a look at this one. Okay, guys, I'm gonna go ahead and end this. I think we might be running out of gas here. So let's just go ahead and see, and of the 8 folks that were able to get it done, everybody got it right, but let's just go ahead and review this one. And you take a look, and we've got what? We've got this corporation that issued 300,000 maturity, issued 300,000 maturity value. That's the face. 12% bonds for 300,000 cash. So they issued them at face. The bonds are dated December 31st, year 1, and mature on December 31st, year 11. Interest will be paid on June 30th and December 31st. What amount of accrued interest should we report at September 30th? Well, if you look at this bond, we did what? We paid interest on June 30th, and now we're what? Looking at September 30th. So we have how many months that are going to go till September 30th? All of July, all of August, all of September, because it's September 30th. Okay, so we have to accrue interest for the 3 months. So we take the 300,000 times what? 0.12 times what? 3/12. Okay, and that gives me, what's the correct answer? 9,000. Okay, so again, sometimes it's a little hard when they put these weird dates in here, and they gave us this distractor date, which didn't help us at all. And, you know, they give us all this information, which was useless. Okay, at the end of the day, the main thing was what? When did they make the last interest payment date, which will be on what? June 30th versus when are they, what date are they asking me? So all those dates, and there's only 2 relevant dates. Question. Okay, in my younger days, I would have tried to force us through the rest of chapter 5. I'm not doing that tonight because I think we've had enough. So what I'm going to do is defer the rest of chapter 5 till next time. It'll, you know, I could probably grind through it in 10 minutes here, but I feel it's wiser to do that next time when we're fresh, and then we'll be able to make a good chunk out of chapter 6 and keep this train rolling. Okay. All right, guys. If there's no questions, I will see you next week. Be on the lookout for your books. If you do get an email from Becker, somebody let me know. I mean, not Becker, from Golden Gate. Let me know if you do, but I'm going to be checking back in with my contact in the mailroom tomorrow to find out what's going on with that, because he did tell me he would send you tracking numbers. Okay, guys.
Thank you.
Talk to you soon.
Thank you. Have a good night.
Thank
too.
you. Good night.